You're now listening to the Taxmart REI podcast, the number one tax podcast for real estate investors. Hey, welcome to this week's episode of the Taxmart REI podcast. Today we're going to be doing a depreciation deep dive. So we know depreciation is everybody's favorite topic because it's such a tax savings tool. So when we talk about cost segregation studies, what depreciation is, how it works, depreciation recapture, how to avoid it, and so much more. If you're interested in reducing your taxes by using real estate, this episode's for you. We'll be diving into all of that in just 1 minute. Are you ready for the 2025 tax changes under the new administration? With new leadership in Washington, the tax landscape is shifting fast. These are some of the biggest updates we've seen in years, and if you're not proactive, you could be leaving thousands on the table. But don't stress, we've got exactly what you need. Access our exclusive 2025 tax changes resource, an in-depth tracker that breaks down what's new, what's changing, and the strategies that you need to stay ahead. This isn't just some generic checklist. It's a powerful and live resource tailored for real estate investors like you. Head on over to www.therealestatecpa.com/2025 tax changes to access this essential resource. You'll get immediate insights into how to navigate the new administration's tax policies and how to keep more of your money in your pocket. That's www.therealestatecpa.com/2025 tax changes, because smart investors don't just make money, they know how to keep it. We'll see you over there, but right now we'll jump right into today's episode. We're back, and Ryan, today we're talking about everybody's favorite topic, depreciation. What it is, how it works, strategies, the whole nine. If you're new to the show, this is going to be an eye-opener for you. If you're a long-time listener, it's going to be a great refresher. Probably going to learn some new things, might even just remind you some things that you already know. First things first, what is depreciation? Why are we even going to be talking about it on today's episode? Ryan, do you mind just taking that away with what exactly is depreciation?
Yeah, depreciation conceptually would be like the intention when we got it from our lawmakers was essentially a expense from the deterioration of a physical asset, right? Over time, you're going to buy, say, a building for $500,000, and over time, that's going to start to deteriorate because it's a physical thing, right? All things kind of generally physically deteriorate. So basically, in 100 years, it's probably still not going to be that exact same material and product that you bought. It's going to deteriorate. And so basically, our lawmakers were saying you can get this depreciation deduction because these things are going to kind of slowly deteriorate. I keep using that word, but that's just what's happening. And really, it's a capital asset that we're deducting the cost over time. And so basically, from the different changes in our law, we've got things like 27.5-year property or 39-year property if we're looking at commercial. We've got things like 15-year property, which are land improvements. We've got things like 5-7-year property, things like that. All of it is around how quickly is that going to deteriorate over time. And we've just kind of come up with these general rules of what things are going to take that amount of time. But it's also just a non-cash expense, right? It's a non-cash expense where, yes, we paid money upfront for this. Like I said, the $500,000 building, that was our purchase. But again, it's from that capital asset, and we're getting that expense that's not continuing to be cash, not like we're paying $500,000 and then we're also paying the expense for this depreciation expense. So that's why we call it a non-cash expense over time that we get to take advantage of. So there's more there, Tom. Did I miss anything there from like a high level overview of depreciation there?
Yeah, no. Long story short, you did a great job. I just summarize that real quick for everybody who's new. Basically, long story short, depreciation, your building deteriorates over time, despite the fact that it might be actually appreciating. But the IRS gives you a depreciation deduction to track that. It's non-cash expense, so that means it reduces your taxable income without necessarily reducing your cash flow. So that's why it's such a powerful tool. We use it in combination with strategies like the real estate professional status and the short-term rental loophole. We'll be talking about all of that throughout this episode, but basically it's a significant tax reduction tool. And if you're investing in real estate, you need to understand how depreciation works so that you can use it to your advantage. So kind of like Ryan mentioned before, there's different types of depreciation. There's straight line depreciation, and then there's accelerated depreciation. With straight line depreciation, exactly what it sounds like. When you have a residential property, that's going to be depreciated over 27.5 years. When you have a commercial property, like an office building or a retail center, industrial, things like that, that's depreciated over 39 years. Okay. With 27.5-year property, you're going to exclude your land value. So something important to understand in this entire conversation is land is never depreciated. Only the building and the improvements is what's depreciated. So when you subtract the land value, you're going to be left with the building. That's typically going to be for residential over 27.5 years. So if you had a property you purchased for $275,000 and that was the building value, let's just say that was the building value, you're going to take $10,000 of depreciation every year. If it was a commercial property, let's just say you bought that for $390,000, you're going to take roughly $10,000 of depreciation each year over 39 years. Very simple. And that's how most properties are going to be depreciated. But there's something called accelerated depreciation, which Ryan kind of referenced before. You have that 5-year property, you have that 15-year property that's depreciated over shorter periods of life. And those forms of depreciation, that 5 and 7-year and 15-year property, can be accelerated using various types of accelerated depreciation, including double declining balance, which we're not going to go through all the nitty-gritty details of double declining balance here, but just know that double declining balance allows you to take more of your depreciation in the earlier years, and it kind of tails off in the subsequent years. It has not really been all that popular when 100% bonus depreciation was still in play. But now that we have bonus depreciation at lower percentages, double declining balance is still used a little bit more. That brings me into bonus depreciation, which is the most potent form of accelerated depreciation. And as we know, if you were an investor from basically 2018 through 2022, you were able to fully deduct or 100% deduct your 5, 7, and 15-year property using 100% bonus depreciation. But that's since started to phase down. 2023, it was 80%, 2024, 60%. This year, currently in 2025, it's 40%. So it's not as potent as it once was, but many of us do believe that with new administration, 100% bonus depreciation will make a comeback. We don't know when yet at this point. There's a lot of talk, a lot of speculation, no concrete answers. So stay tuned to the podcast. As soon as we do have information on that, we will be releasing. In fact, we have Nate coming up on a future episode. He's going to help debrief where we are with 2025 tax changes. But just know right now in 2025, we have 40% bonus depreciation. And you might be asking yourself, well, okay, we have our building is 27 and a half years or 39 years. How do we find out how much of our building is actually going to be depreciated over 27 and a half or 39 years versus what's eligible for this 5, 7, and 15-year property, which can be accelerated? And that's just done via cost segregation study. Long story short, cost segregation study, an engineer comes down to your property and surveys it, breaks down all the various components, and gives you a report and says, hey, this amount of your property is 5-year, 7-year, 15-year, 27 and a half, or 39 years if it's commercial. That's how it's done. The reason why this is important, just to tie it up, and then I'll pass it off to Ryan for how you can actually use this or what this actually means for you, is that you generally want to accelerate your depreciation and take more of it up front thanks to the time value of money, right? If you can use this depreciation to help you offset your rental income, or if you use like the real estate professional status or short-term rental loophole, which we'll talk more about, then this can help offset your W-2 or your active business income for even additional tax savings.
Yep. And just to tie something before we move on, Tom, a common just like terms that are out there, and people, when talk to them, they're just like, I've heard of accelerated depreciation, bonus depreciation, cost segs. I don't really know how they all fit together. So I just wanted to take a minute while we're talking about depreciation, kind of how this all works. So a cost segregation study is going to help you determine of your cost for the purchase of this building land, how much of that falls into, like Tom said, the 5, 15, 27 and a half, for example, right? So basically, once we've got the 5 and 15 that has a useful life of less than 20 years, they basically, at the current law, are eligible for bonus depreciation. Bonus depreciation is essentially a form of accelerating depreciation, is maybe one way to kind of look at it. So cost segregation study helps us determine what can be accelerated to 5 and 15. And then bonus depreciation is kind of like the type of acceleration that we can get, how quickly, right? Is it 100%? Is it 40%? Is it we have to depreciate it over 5 years? Is it over 15 years? That kind of thing. So maybe just some terms there that maybe you've heard on our podcast a lot, and just wanted to take a second here to kind of help people like dissect where do they kind of fit in and how do they relate together. Now, moving on to just some other things like Tom was mentioning too. So as we think about accelerating depreciation with something like a cost segregation study, then we're starting to determine, okay, is this valuable to me to get a cost segregation study done? Because it's going to cost money. There's going to be a fee. Whether it's more of a do-it-yourself software option that's a couple $100, maybe $750, to you've got a full-blown engineering study, which could be thousands of dollars, something like that. The value of that additional fee and accelerating the depreciation in a form of tax savings is going to depend partly and largely if you've got passive losses or non-passive losses. So passive, you guys have heard us on the episode here talk a lot about real estate in general is passive. And then the non-passive is going to be, do we meet something like real estate professional status or the short-term rental strategy? If we're meeting one of those, then we're starting to use non-passive losses. And the benefit of a cost segregation study and depreciation as a whole to get that accelerated just becomes that much more valuable. Okay. But it doesn't mean, I just want to highlight this one thing real quick. A lot of people think if my losses are going to be passive, then I cannot take advantage of, or it doesn't make sense to do a cost segregation study, period. That is not true, because that then leads me into a strategy, which you've probably heard called the lazy 1031 exchange. Okay. So the general idea is that if you are, for example, selling a rental property, you've essentially got a passive gain. It's going to come through on your tax return and you got to pay tax on that. Well, passive can offset passive, right? Passive gain can be offset by passive losses, whether they were suspended in the past or their current year losses, right? It's all kind of passive. So the idea here is that we can basically find value in doing a cost segregation study, even if you have no non-passive losses from real estate, if it means that it can offset a passive gain. Okay. Again, so oftentimes people call that the lazy 1031 because basically we're using no non-passive rules here like real estate professional status or the short-term rental loophole to then actually get us some tax savings. And personally, I'm probably going to do this a lot this year. I am in communication with my realtors to basically sell a bunch of my portfolio, and I'm basically planning to do this. I'm not using real estate professional status. I'm not using the short-term rental loophole. I'm actually using this strategy probably a lot this year, hopefully. So this is something that's very common if you're looking to sell. Okay, this is usually when this kind of comes up.
With 2024 officially in the rearview mirror, now's the perfect time to start planning for how you're going to maximize your tax savings in 2025. With major tax changes looming under the new administration and IRS audits on the rise, navigating the tax code alone is now riskier than ever. Whether you're leveraging the short-term rental loophole, claiming the real estate professional status, utilizing passive losses, 1031 exchanges, or anything in between, our expert team of tax advisors at Hall CPA has your back. We'll help you uncover hidden opportunities and avoid costly mistakes that could put you at risk during an audit. With potentially tens of thousands of dollars of tax savings on the line, why wait? Visit www.therealestatecpa.com/podcast to request your free 30-minute discovery call today. Again, that's www.therealestatecpa.com/podcast for a free consultation. Let's help you ensure you keep more of what you earn in 2025. That's all for now, and we'll dive right back into today's episode. One thing I just want to add, I hear a lot of things out there. I'm on forums or just questions that I get asked is like,
can I deduct my depreciation? Can I use my depreciation to offset my W-2 income or my business income?
And the reality is you're not really using your depreciation to offset your W-2 income. It's the losses that are generated as a result of depreciation. And like Ryan said, it's either passive or non-passive. If it's passive, then it's going to help you offset your rental income or income that you have from other passive activities, primarily going to be rental income for many people listening to this show, which has benefit, right? Rental income is taxed up to 37%, your ordinary income rates. If you're a high income earner and you could shift some of your income into passive income, then depreciation helps you shelter that. You're saving money on taxes, right? And then if you have excess losses, when you sell a property, it can help you offset. Like Ryan said, what he's going to do with his portfolio can help you offset the capital gains. So there's value in it being passive, right? It's just something I want to point out there because a lot of times people think if it's not non-passive, there's no benefit. Having said that, if you are on the passive side, it may not always make sense to do a cost segregation study, right? If you're selling your property, probably worth doing a cost segregation study, right? On a prior property or another acquisition that you made maybe in that year to help you offset that capital gain. But where, it's really quite powerful is when it's non-passive and you can use the short-term rental loophole or you can use the real estate professional status to turn losses from your rentals non-passive. And we're not going to talk about those two strategies too much here on this episode. Honestly, we have so many episodes about it on it. Just scroll through the feed, you'll see it. So if you do want to learn how to use the real estate professional status or short-term rental loophole, again, go check out those episodes. We have an entire series on it, reps and STRs. Basically, there are strategic ways to use depreciation, and you should definitely be looking into how you could use it.
Yeah. Before we move on, Tom, I just wanted to mention the reason that something like the real estate professional status and the short-term rental loophole with a cost segregation study, kind of combining these things, is because we get the losses now, right? It's kind of like a timing to we use the word accelerated, and it's getting the losses now to offset your W-2 or business profits, whatever kind of other non-passive income you have. But what I'm talking about for my situation Basically, I've over time owned real estate since 2017, and I have been passive the whole time. So I have now, through not perfect portfolio, growth and cash flow, kind of accumulated a lot of losses over time. And now I'm going to trigger those losses to come in now. Okay. So the detriment to me from a tax perspective is I've had to wait because they've been suspended, right? So had I been able to now unlock all of those losses from maybe I'll use this year in tax year 2025 to back in 18, 17, whatever, I was at a different tax bracket then. But the time value of money says if I had gotten all those savings back then, I would have been better off, right? That's kind of the theory, and that's just the way the math works. But all of this is just one I wanted to comment on. This is basically a timing mechanism. We're kind of accelerating these things to either the now or, like in my case, I've had to kind of wait to take advantage of these, but the losses don't go away. Okay. Whether you accelerated them or not via depreciation, like Tom said, it's all about the ultimate bottom line loss number that you're kind of getting to use for like the lazy 1031, for example. That's what we're ultimately getting to use as far as passive losses. But again, accelerating that depreciation from, say, I go do a new investment somewhere or even in a syndication, cool. If I'm getting a huge loss, I can use some of that to offset my passive gain with the 1031 light or lazy 1031, like we call it. So just want to comment on that before we moved on to help people.
Yeah. Now we have to just move into the dark side of depreciation. There's a dark side, and don't worry, there's a light at the end of this tunnel, and we'll talk about that too. All right, so when you take depreciation, you're depreciating, like we kind of mentioned before, you're depreciating a capital asset. A capital asset is not immediately deducted. You're not buying your property and immediately deducting the entire thing today. This is not how it works. Even with 100% bonus depreciation, it's not the entire thing. So what happens is you have the cost basis, and every time that you take a depreciation expense, so every year, that's going to reduce your cost basis. And when you sell your property, okay, so say you bought a property for $500,000 and it appreciates to $800,000 and you sell it after 10 years. Let's just say 10 years for the sake of argument here. Your true gain on the sale is not going to be $300,000. That's going to be your capital gain, okay? And that'll be taxed at capital gains rates, in this case, long-term capital gains rates. But also, it's going to be the amount of depreciation that you've taken over the years of your property is going to reduce your cost basis. So let's just say, for example, to give you an example here, you purchased the property for $500,000, and let's just say you took $200,000 of depreciation over the course that you owned it. And I'm just ballparking these numbers for the sake of example here, okay? Then your cost basis would be $300,000. So when you sell your property for $800,000, okay, your true gain is going to be $500,000. $300,000 of that, again, is going to be the capital gain. $200,000 can be subject to depreciation recapture. So depreciation recapture is a tax that you have to pay on the depreciation you've taken over the course of the time you've owned the property. Now, there's different types of depreciation recapture. There's section 1245 recapture, which is depreciation taken on that 5-year property. Okay, so if you used any type of accelerated depreciation or you just depreciated 5-year property, you're going to be subject to ordinary income tax rates up to 37% under current law, plus state taxes, so on and so forth, on that section 1245 property. Then there's something called 1250 recapture, and that is from accelerated depreciation on section 1250 property, which is land improvements, basically, that 15-year property. And then there's going to be depreciation from straight line depreciation, that 27.5 or 39-year property. So the 1245 and the 1250 recapture, so those land improvements, that's going to be subject, when you accelerate it, is going to be subject to that ordinary income tax rate, okay? Whereas the straight line depreciation is going to be subject to a max rate of 25%, okay? So those are just the tax rates just to be aware of on the depreciation recapture. Now, when we get to this point, we're having the conversation with somebody, a client, potential client, whatever the case is, I usually start asking, well, Tom, so wait a second. I'm going to have to depreciate my property and then I'm going to have to pay it back in taxes. Why would I do that? Why would I want to depreciate my property at all? Why would I want to accelerate my depreciation? Well, first of all, you have to take depreciation. If you don't take depreciation, the IRS will assume you did, and they'll charge you the depreciation recapture tax anyway, okay, for the depreciation that you either taken or could have taken during that time. So you have to take it. That's number one. Number two, why would you accelerate that depreciation? Well, we've kind of already addressed it. A lot of times you would consider accelerating the depreciation so you could take the deductions now, then take the tax savings and use it to reinvest and continue growing your portfolio. And we know with the time value of money, $1 today is worth more than $1 tomorrow. So that's why you'd want to do it. But there's also good news. And as if you have a long-term view on real estate and you take the longer perspective and you're going to be in real estate for decades or perhaps for life, then there are ways to mitigate this depreciation recapture tax. And that is primarily through the 1031 exchange. I'm not going to do a tear down here of the 1031 exchange here today. But just know the 1031 exchange, when you sell your property, allows you to defer your capital gains and depreciation recapture tax when you reinvest the sales proceeds into another investment property. So if you buy a property today, you use accelerated depreciation, you're able to offset your W-2 income, or maybe you're using it to offset the gain on sale of another property, whatever the case is. When you sell that property, you can use a 1031 exchange to defer that, and you can continually do that over and over and over again throughout your lifetime. And then when you pass away, your heirs will inherit the property at a step up in basis, essentially resetting your tax basis and eliminating all the capital gains and the depreciation recapture tax. So that's how you kind of deal with depreciation recapture. Understand that you have to take depreciation. And when it comes to depreciation recapture, it can be mitigated if you're in the game for the long term.
Yeah. And some people, if you're listening to this and you determine that, hey, real estate isn't my thing, I'm just going to get out. Okay. Like you're just going to get out, right? What this works well for is if people know that they're going to like upgrade or they want to get out of a specific property and they've got a decent gain and maybe a lot of equity, then great. Let's defer that kind of depreciation, recapture, capital gain, and let's move that into another property, right? Using a 1031 exchange. For those of you who are just like, I just am going to get out, was this beneficial? Maybe it's going to depend on how long you held that property and kind of that time value of money. But like we're saying, this is a long-term play as we think about real estate and getting the accelerated depreciation. This is really who this is going to be most beneficial for, those who are looking to do that. And like Tom said, this is like the most common way. We're very comfortable with this in helping people walk through that. And yeah, there's the dark side, absolutely, that maybe we don't talk about enough. We talk about a lot of the benefits, and we just wanted to especially take some time to kind of think through some of the latter part when we exit and some strategies there. So don't be caught off guard with this. That's why we're talking about it. There's a ton of benefit, but we do need to think through long term. Should you even do something like we talked about earlier, a cost segregation study? That's why normally if you talk to people in the industry, it's like, if you're going to hold this for like 2, 3 or more years, then a cost segregation study can be really beneficial. Don't see this as like a quick, like, hey, I'm going to do this cost segregation study and then sell it in 1 year. That's probably not going to make sense to kind of accelerate all that depreciation unless you're going to do something like a 1031 exchange. So I think that's some additional comments I wanted to throw in there as we're thinking about this.
Let's just wrap this up with a quick recap of what we learned here in today's episode about depreciation, one of the most critical expenses and most important expenses for real estate investors. All right. First, depreciation is a non-cash expense that only shows up on paper and has the power to create a loss for tax purposes, despite the fact that you might actually be making money or you might have positive cash flow on your rental property. So very powerful tool. And really what it is, to go beyond that, the reason why you get the depreciation expense is because it tracks the deterioration of your property as it falls apart over time, despite the fact, again, that your property might actually be increasing in value. Okay. So that's kind of what depreciation is and what the benefit of it is. Now, when it comes to the depreciation, you're going to have straight line depreciation or you're going to have accelerated depreciation. All right. The accelerated depreciation rapidly increases your depreciation expense, usually in the first year with bonus depreciation, or in the early years when you're using the double declining balance, which is still kind of used today as bonus depreciation begins to phase out. Now, when it comes to accelerated depreciation, it doesn't always make sense to accelerate depreciation. The reason for that is because you have to usually get a cost segregation study performed to be able to get the breakdown of the various components in your property that are eligible for accelerated depreciation, typically 5, 7, and 15-year property. Okay. When it does make sense to actually go ahead and do that, the cost segregation study is usually in one of 3 circumstances. A, you qualify for the real estate professional status, which allows you to take losses from your long-term rental properties as non-passive. B, you qualify for the short-term rental loophole, which allows you to take losses from your short-term rental properties as non-passive to offset your W-2 and active business income. Or 3, when you're selling another property, and you want to use the losses from a property you acquired in the same year, or perhaps you already have in your portfolio, to use those losses to offset the capital gain and depreciation recapture from the sale of another property. So those are the three main reasons why you'd want to use it. I suppose if you had a lot of passive income from other properties, that could be the fourth reason, although I'd say that's less common that we see that actually play out. But those are the reasons why you would want to accelerate depreciation. Now, there's depreciation recapture, and that's a tax you have to pay on the amount of depreciation you have taken over the time that you own the property. And you have to take depreciation, so you cannot avoid it. You have to take it. So the way you can mitigate your exposure to depreciation recapture is by using a 1031 exchange to sell your property, buy another one, reinvest the proceeds into another property, or by using the lazy 1031 exchange, which is when you sell one property, you buy another one in the same year, or it could be in any order as long as both happen the same year. And then you use the cost segregation study and accelerated depreciation, like bonus depreciation, to offset the capital gain from the sale of your original property. So that's in a nutshell what you need to know about depreciation. If you do have questions about depreciation, go ahead and send us an email at contact@therealestatecpa.com, or by joining our Facebook group, the Taxmart Investors Facebook group on Facebook. We'll be taking questions from there on our next live Q&A episode. So you don't want to miss that. Also, if you do want someone just to help you shortcut this entire process, shortcut the learning curve for you, and look at your situation, tell you exactly what you have to do for your situation, how you can use depreciation, how you can use all these other strategies we talk about on the show to help you reduce your taxes, then you can go ahead and request an initial consultation at www.therealestatecpa.com/podcasts. And we'll see you over there. That's it for today's episode, and we'll catch you on next week's episode of the Taxmart REI podcast.